Welcome to new video lessons of CFA Learning. Study session number 4, reading number 10. Today's topic is, currency exchange rates, understanding equilibrium value. Before get started, subscribe our channel and hit the bell icon to get the latest videos. Foreign exchange market concepts. 2 points about bid offer quotes. Offer price is always bid price. Counterparty who inquires price quote will have the option to deal at either the bid or offer price quoted to them by the dealer. Size of bid-ask spread depends on the following factors. The currency pair involved more liquid currency pairs, bid-offer spread. The time of day. The interbank FX markets are the most liquid when the major FX trading centers are open. Low spreads. Market volatility. Uncertainty about the factors influencing price, wider bid-ask spreads. Size of transaction. Larger the transactions, wider the spread, greater difficulty the dealer faces in laying off the foreign exchange risk. Relationship B/W. The dealer and the client can also affect the size of the bid-offer spread. Arbitrage constraints on spot exchange rate quotes. 2 arbitrage constraints to avoid riskless arbitrage opportunities. The bid, offer, shown by a dealer cannot be higher, lower, than the current interbank offer, bid. The cross-rate bids, offers, posted by a dealer must be lower, higher, than the implied cross-rate offers, bids, available in the interbank market. Forwards agreements to exchange one currency for another on a future date at an exchange rate agreed on today. Forward rates must satisfy an arbitrage relationship that equates the investment return on 2 alternative but equivalent investments. An investor with 1 unit of DC to invest for 1 year faces 2 alternatives. Invest cash for 1 year at the domestic and at the end of year, investment would be worth. Factors that determine spot bid-ask spread, e.g. liquidity, transaction size etc., also determine bid-offer spread for forward swap. Mark-to-market value of forward profit/loss that would be realized from closing out the position at the current market price. A long-term framework for exchange rates. Trading decision in FX markets lays a view on future market prices and conditions. Decision to be fully hedged implies that future market conditions are very uncertain. International parity conditions determine long-run movements in exchange rates, IR and inflation. Following concepts must be clearly understood. Long run v/s short run. Real v/s nominal values. Expected v/s unexpected changes. Relative movements. International parity conditions. Key international parity conditions rarely hold in either the short or medium term. 2 reasons to study international parity conditions. Each condition reflects economic forces that should not be ignored altogether. Currency positions offer profitable opportunities only when parity conditions fail to hold. Covered interest rate parity. An investment in a foreign money market, completely hedged against exchange risk, should yield exactly the same return as an otherwise identical domestic money market investment. If this parity does not hold, arbitrage profit is possible. Assumptions: no transaction costs, identical instruments. Uncovered interest rate parity. The expected return on an uncovered FC investment should be equal to the return on a comparable DC investment. Expected exchange rate differential equals yield differential. Country with IR is expected to see the value of its currency depreciate. This parity relationship works better over very long-term horizons. Forward rate parity. If both covered and uncovered IR parity hold, forward exchange rate will be an unbiased forecast of the future spot exchange rate. Forward exchange rates are poor predictors of future spot exchange rates. Without using any current information to predict future spot rates, the random walk prediction can be slightly biased. Purchasing power parity. Law of one price: identical goods should trade at the same price across countries when valued in terms of a common currency. Absolute versions of PPP equilibrium exchange rate B/W. 2 countries is determined entirely by the ratio of their national price levels. Due to significant transaction costs, this relationship does not hold. Relative version of PPP%D in spot rate will be completely determined by the diff. B/W the foreign and domestic inflation rates. Ex-ante version of PPP expected changes in the spot exchange rate being entirely driven by expected differences in national inflation rates. The Fisher effect and real interest rate parity. International Fisher effect. Foreign, domestic yield spread equals foreign domestic expected inflation differential, assuming real IRR equal across markets. Fisher effect examines how IR, and inflation rates interact. Carry trade. FX carry trade. It involves taking long positions in high-yield currencies and short positions in low-yield currencies, funding currencies. The idea behind this trade is that the high-yield currencies on average have not depreciated, and low-yield currencies have not appreciated to the level predicted by IR differentials. During periods of low volatility, carry trades tend to generate plus VE excess returns, prone to significant crash risk in turbulent times. Valuation overlay approach to manage downside crash risks. High yielders will be overweight and low yielders will be underweight when ER lie inside prescribed PPP bands. Dangers of carry trade. Create ER misalignment around the world. Can cause a serious currency or financial crises. The impact of balance of payments flows. Current AC balance sum of all recorded transactions in traded goods, services, income and net transfer payments in a country's overall BOP. Countries that run persistent current AC deficits, surpluses, often see their currencies appreciate, over time. The current AC must be matched by an equal and opposite balance in capital AC, to balance BOP account. Financing decisions are usually the dominant factors in determining ER movements. There are 4 reasons for this. Prices of real goods and services adjust more slowly than ER and other asset prices. Production of real goods and services takes time. It reflects financing of current expenditures and also reallocation of existing portfolios. Expected ER movements can induce very large short-term capital flows. Current account imbalances and the determinations of exchange rates. The flow supply/demand channel. Purchases and sales of internationally traded goods and services require the exchange of domestic and foreign currencies. Countries with persistent current AC surpluses would see their currencies appreciate over time and vice versa. The amount by which ER must adjust to restore current accounts to balanced positions depends on a know of factors. Initial import and export gap. Response of import and export prices to D in ER. Response of import and export demand to D in import and export prices. The portfolio balance channel. Current AC imbalances shift financial wealth from deficit nations to surplus nations, lead to shifts in global asset preferences, exert an impact on the path of ER. The debt sustainability channel. Persistent current AC imbalances for deficit nations, ever-rising net external debt levels as a percent of GDP, steady downward revision in market expectations of the currency's real long-run equilibrium value. Capital flows and the determination of exchange rates. Excessive surges in capital inflow to M may cause economic or currency crises. By contributing to an unwarranted real appreciation of the M currency. A huge buildup in external indebtedness by M government, businesses, or banks. Property market or financial asset market bubble. A consumption binge and overinvestment in risky projects. Equity market trends and exchange rates. The relationship B/W equity market performance and ER is not stable. Judgments on possible future currency moves, based solely on expected equity market performance, is difficult. Monetary and fiscal policies. The Mundell-Fleming model. Changes in monetary and fiscal policy affect the level of IR and economic activity, leads to changes in the direction and magnitude of trade capital flows. Change in the ER. Expansionary monetary policy. With flexible ER. Domestic IR capital flow to higher yielding market value of DC. In currency value will net exports. With fixed ER. Monetary authority will have to buy its own currency to prevent depreciation. Result: tight domestic credit conditions to offset the intended expansionary monetary policy. Expansionary fiscal policy. With flexible upward pressure on domestic inflow of capital from lower yielding markets, upward pressures on DC. With fixed monetary authority will have to sell its own currency in the FX market to prevent DC appreciation. Some insights of this model. Objectives of independent monetary policy: free capital flows and to defend fixed cannot be satisfied at same time. Degree of capital mobility is critical to the effectiveness of monetary and fiscal policy in an open economy. View the table for monetary fiscal policy mix and the determination of exchange rates under conditions of high capital mobility. View the table for monetary fiscal policy mix and the determination of exchange rates under conditions of low capital mobility. Monetary models of exchange rate determination. Under these models, output is fixed and monetary policy affects through the price level and the rate of inflation. The monetary approach with flexible prices. An extension of the classical quantity theory of money to an open economy. According to quantity theory, money supply the primary determinant of price level PPP holds. In a pure monetary approach model, a change in the money supply future growth rate would have no immediate impact on the current The Dornbusch overshooting model. Shortcoming of pure monetary approach: assumption that PPP holds at all times. PPP rarely hold in short or medium run. Dornbusch model assumes that output prices exhibit limited flexibility in short run but are fully flexible in the long run. Long-run price level flexibility ensures that an in-domestic money supply will give rise to a proportional in domestic prices and contribute to a depreciation of DC in long run. If domestic price level is assumed to be inflexible in the short run, the is likely to overshoot its long-run PPP path in the short run. Portfolio balance approach. Role of monetary policy in determining expansionary, restrictive, monetary policy: downward, upward, pressure on DC value. Impact of fiscal policy on ambiguous. Mundell-Fleming model: short-run model of determination. Portfolio balance approach: global investor will hold a diversified portfolio of domestic and foreign assets including bonds. A steady in the supply of domestic bonds outstanding. Continued widening of the government budget deficit compensated in the form of could come from IR/risk premium. Immediate depreciation of the currency to a level sufficient to generate anticipation of gains from subsequent currency appreciation. Govts that run large budget deficits on a sustained basis could eventually see their currencies in value. Combination of Mundell-Fleming and portfolio balance models: expansionary fiscal policy may be plus VE for a currency in short run but VE in the long run. View diagram of the short and long run response of exchange rates to changes in fiscal policy. Exchange rate management, intervention and controls. Capital inflows: blessing if they enable growing economies to bridge the gap. B/W domestic investment and savings. Capital inflows: curse if they fuel boom-like conditions, asset price bubbles and overshooting of the currency into overvalued territory. Upward arrow in capital inflows are caused by combination of pull and push factors. Push factors, plus VE developments that attract overseas capital into the economy: relaxed regulations, liberal MKTs. Flexible exchange rates, privatization of state-owned entities etc. Pull factors, developments in other economies that cause capital to flow to a particular economy attract high-yielding economies become attractive amid low interest rates policies or ultra-low interest rates in developed economies. Governments directly intervene to resist excessive inflows and to avoid currency bubbles. Warning signs of currency crises. 2 School of thoughts with respect to currency crises anticipation. 1. Deteriorating and weak economic conditions are warning sign for currency crises. 2. No particular factor as crises can occur out of the blue. View graphical presentation to anticipate crises. Some factors are highly interrelated and often one factor leads to another. That is all for today. Find some reading help. Thank you for watching. We hope this information is useful to you. Don't forget to subscribe to the channel, add like and share the videos. You can also ask the question, we will happy to answer.